Big news, everyone. Trump just announced that he's taking immediate action to ban institutional investors from buying single-family homes in America. He just posted this on Truth Social. It's now all over the news. The question is this actually going to happen? And if it does, what's the impact going to be on the U.S. housing market? Well, the first thing to understand about this, everyone, is that number one, it needs congressional approval to happen. And number two, we still don't know the exact specifics. However, if it happens, we could see big institutional Wall Street investors like Invitation Homes, American Homes4Rent, First Key Homes, Progress Residential, Tricon Residential, kicked out of the housing market. These investors own tens of thousands of homes, and by some estimates, institutional landlords own anywhere from 500,000 to 1 million houses across America. And so if we ban them from buying, it could have a big impact on short-term demand in the market and where prices go. In particular, I'm expecting that if we ban investors from buying houses, we will see home prices drop in metro areas like Atlanta, Phoenix, Las Vegas, Nashville, Tampa, Charlotte, Dallas, and Houston. These are areas that are havens for the big Wall Street institutional investors. They buy up lots of homes in these cities. For instance, if you look at American Homes4Rent's ownership portfolio, you can see that 45% of their homes are owned in only 7 cities in the Sun Belt. At the bottom of the last housing crash in 2012 is the first time that we saw investors build up capital and deploy it into the market. Blackstone was one of the first to do it, and they eventually spun off Invitation Homes as a publicly traded REIT. Invitation Homes owns around 76,000 homes across the US. Their stock is down 6% today because of this announcement from the Trump administration. So we're already seeing Wall Street react. Invitation Homes is down 6%. American Homes4Rent, the other big Wall Street landlord who's a REIT, is down 4 to 5%. Even D.R. Horton, the big home builder, is down 3 to 4% on this news. And so this begs an interesting question, everyone, and I'm seeing some debate about this. Is this actually a good idea? Is banning the institutional investors from buying homes a good idea? And how is it going to be enforced? Well, I polled you guys and I asked you the question, do you think corporations should be banned from buying houses? And the response was overwhelming. Over 80% of you think corporations should be banned from buying houses here on this poll on YouTube, which already has thousands of responses. I ran a similar poll on X. Over 70% of my X followers think corporations should be banned from buying houses. So this is a nonpartisan issue, it seems like. Both Democrats and Republicans seem pretty uniform, both sides of the political aisle, as well as independents, in thinking that corporations should be banned. And just here's some numbers so you can understand kind of the extent of how much they buy. According to Rick Palacios from John Burns Real Estate Consulting, institutional investors who own over 100 properties purchased 1.2% of all the houses in the U.S. that sold in the third quarter of 2025. 1.2%. So, that's kind of a smaller number. It signifies how we're not going to solve every aspect of the housing crisis and affordability crisis by banning institutional investors. However, that number varies significantly by location. If you were to go to Atlanta, that number is closer to 5%. If you were to go to certain neighborhoods in Atlanta, that number is closer to 20% or higher. So there's certain neighborhoods in a market like Atlanta to the south of Atlanta where if this is enacted, we could see prices go down a lot. Similarly, west of Phoenix, in an area like Glendale, that's another investor haven where if the institutional investors were told to stop buying, we would see demand go down by a lot, supply would go up, prices would go down. Other parts include southeast of Nashville towards Antioch. The investors bought up a lot of homes there as well. In DFW, they own a lot of homes to the east in Mesquite, to the west in Arlington, as well as in Fort Worth. In Houston, they own a lot of homes to the north in Spring. There are a lot of neighborhoods that will have a huge impact if this happens. Now, there's other neighborhoods where there won't be any impact. And this is what I want to be perfectly clear to everyone watching this channel, is that if this happens and we ban Wall Street and the institutional hedge funds and corporations from buying, certain markets will feel no impact. For instance, upstate New York, where I'm from originally, near Albany, New York, includes Syracuse and Buffalo. Investors don't buy up there. Institutional investors have no presence up there. If you go to Boston, institutional investors have a very small presence. If you go to Chicago, they have a very small presence. So in the Northeast and Midwest, if we look again at where Invitation Homes owns their homes, we don't really see much representation at all. Invitation Homes, the biggest Wall Street publicly traded owner, owns about 30% of their homes in Florida, 40% in California, and 25% in Georgia in the Carolinas. Again, very concentrated. Interestingly, folks, I'm actually walking around a home building development right now in Little Rock, Arkansas. I'm on a road trip across the U.S. housing market to start 2026. I'm going to show you what some of these houses are selling for in a second, because the builders actually have a big part to play in this as well, which I'm going to explain in a second. As I've been traveling around the U.S. over the last couple months, everyone, I've been noticing more and more investors buying in home builder sites. This is a trend I've been noticing it, and you guys can let me know if you've also noticed it from my reporting. I'll go to a home building site and all of a sudden find like 4 homes for rent, and the home building site is only half built. I'll go to another home building site and there'll be a big chunk of homes that are all for rent that were sold off to one investor. This is something I never really noticed 2 to 3 years ago. I'm noticing it more over the last year. And so what I think is happening is that these big Wall Street investors, have pivoted from buying a lot of single family homes. During the peak of the pandemic, they purchased over 3% of the houses. That's down to 1.2%. But the concentration is now more mixed towards being in builder sites. And so an interesting question to ask here in this legislation and proposal of banning corporations is, should we ban them from buying in home builder communities? Because I think that's a little different than buying a house that's existing on the resale market in an established neighborhood. If a builder buys a house that was built 40 or 50 years ago in a neighborhood, they are quite literally taking a house that was owned and turning it into a rental, which is not good for the average American. That's not good for the long term of the American dream. However, if an investor were to buy a house from a builder, and if theoretically the builder were to increase the supply of their construction in response, that's not necessarily harming the average American home buyer. In fact, it could be helping the average American home buyer by spurring builders to build more. And I personally think the builders, are still building a decent amount even for the downturn in the market. And a lot of that simply has to do with the fact that I think investors are buying a lot from the builders. Why did D.R. Horton's stock price go down today on this announcement? It's because it's no secret. D.R. Horton does sell quite a few homes to investors. So does Lennar. So do a lot of these builders. And so do we want to stop that? Or do we want to continue to allow investors and corporations to buy from builders? I think that's an interesting question. You guys can let me know what you think. At the very least, we should definitely allow these big corporations to build their own homes. I mean, American Homes4Rent actually has a pretty big building division. They're now in the top 40 home builders of America, American Homes4Rent. They build their rental communities now. I think that's probably something we should still allow. We still want more actual supply to get built, and we don't want to introduce a policy that would potentially lower how many homes are being built. So we still want to see those homes built. Now, in this case, everyone, these houses are in a pretty residential area of West Little Rock. Now, West Little Rock, Arkansas is actually a fairly wealthy area. The median income here is over $100,000. I've been staying here the last day and a half. It's actually surprisingly nice. Little Rock, has a reputation as being not so nice. As a city, its crime rates are some of the highest in the US. However, out here in the suburbs, it's much nicer. Prices here are actually fairly affordable, although in this building community, they have some townhomes on the market for like $320,000, $340,000, and they also have some single family homes. And you could see they're preparing to build even more here in the future here in West Little Rock. I'm liking Little Rock a little more than I liked Memphis. I was in Memphis 2 days ago on my road trip where I'm heading west, and Memphis was interesting. Memphis, the prices are really affordable. There's actually a lot of value in Memphis's housing market. I found houses in Memphis that were 5-bed, 4-bath, 120-year-old homes that were beautiful, where the price has been cut 28%, selling for $100, $110 a foot. Like, if you're an investor that wants cash flow, Memphis is actually a good place to go. However, Memphis does have issues with crime. And this is something I noticed when I was there. You could feel it. Memphis has almost like a San Francisco type vibe. Like if you went to San Francisco 2 or 3 years ago when San Francisco had its peak crime issues, Memphis kind of feels similar. The downtown area is kind of vacant and empty. There's a lot of homeless people. There's a lot of people that look sketchy, and the violent crime rates there are through the roof in Memphis. It's the highest violent crime in the US. Here's more homes that they're building here, everyone. You can let me know what you think of these houses. I actually think it's kind of nicer than some of the other builder communities I've been to recently. And there we got the land being paved and raised and paved, more houses coming. And you know, Memphis also has some nicer neighborhoods kind of far out from the city, but most of the area in and around downtown and midtown Memphis does feel a little dangerous. And so if you're an investor, you have to ask yourself the question, would you want to buy a cheap house or a cheap condo? You can find condos for $60,000 in Memphis right now. Pretty good cap rates. Would you want to do that, but still have to deal with potentially some of the crime issues that the city has? The city says crime is down 44% year over year. It's improving, but I can tell you boots on the ground, it feels like it's still pretty bad. Tickets to a Memphis Grizzlies game are $5 on StubHub. Memphis Grizzlies are an NBA basketball team. Their arena's downtown. People don't want to go. Tickets are $5. That's kind of a bad sign, right, for the city. But Little Rock, West Little Rock feels a little bit better. Some nicer developments to the west part of town. Cheap property taxes. You can find houses around this area not too far away for less than 250 grand. That could be decent investments. And I think this is interesting to talk about, is the composition of who actually owns investment properties in America. According to John Burns Consulting, there's 14 million single-family investment rentals in the US right now. 14 million, which is a lot. That's 14% of the housing stock. There's some other estimates that say the total amount of investor-owned homes can go up to 24 million if you include condos and other property types. So it's a lot of investor-owned homes, significant amount. However, if you look at the ownership breakdown of the investor-owned homes, it is mostly mom and pop ownership. Mom and pop ownership, less than 10 units, is over 80% of all the investor-owned homes. So if we squarely focus on just the corporate investors, are we missing something here? Like, are we only maybe just kind of doing a surface level change in policy on the housing market? Instead, do we also need to focus the gaze on the mom and pop investors or the investors that own 10 to 100 homes? They own a majority of the US housing stock. And one thing I would actually suggest to the Trump administration is that this banning of corporations should be your leading salvo here. This should be your opening act. But I think there should be more that follows it if we want to really get serious about deterring investors from buying, incentivizing investors to sell. One thing we might want to look at is changing the tax deduction rules for real estate investors. Right now, if you buy a house, if you were to buy this house behind me as an investor, you can depreciate the structure on a useful life of 27.5 years. What that means is that if the structure, say, is worth 250 grand, I'm just throwing that number out there, you could take 250 grand, spread it over 27.5 years, which is around 3.5% a year, and you could reduce your tax bill by that amount of the depreciation. And this depreciation expense is one of the reasons that investors, both big and small, buy and continue to own houses. What if we said, hey, let's get serious about kicking some of these investors out of the market. Let's increase that depreciation timeline to 39 years. 39 years matches what it is for commercial properties. If we were to increase it from 27 to 39 years, that would mean that investors wouldn't be able to claim as much depreciation expense per year, which would mean it's not as profitable for them to own the home. And I bet you would see a lot of investors sell if that happened, and it would decrease the incentive to buy. And I think that's really like the next step if we want to get really serious about this. And I think the Trump administration does. Like if you look at Don Jr.'s retweet of his father's post on Truth Social, he's talking about how, you know, Trump wants to make houses more affordable. He wants to lower home prices, is what Don Jr. said. I think we got to take it to the next level. We also got to say, hey, we got to change the tax structure a little bit, because it really favors investors owning rather than selling. And here's something crazy, everyone, about how our tax structure and policy works. I don't know if you guys know this. We, as a federal government, we incentivize investors to own real estate and hold it by giving them the depreciation expense deduction on their taxes. but then we penalize them if they sell by charging them an excessive capital gains tax of 20%. So think about some investor who maybe bought a couple properties 20 years ago and has a lot of appreciation. They can either choose to hold or sell. Well, if they hold, they can still deduct, some of that depreciation expense. But if they sell, they're going to have a massive capital gains tax liability at 20% of their gain. In that situation, which it is right now, they're just going to keep holding. So why don't we also, in addition to lowering the depreciation, why don't we also give them a capital gains tax holiday? Why don't we give them the ability, especially long-term investor owners, why don't we give them the ability to sell at a reduced capital gains tax rate and make it a point to get these owners to sell? And that's going to unlock a lot of inventory. I know, I have some investors who watch this channel and might not be liking some of the things I'm saying, but I'm curious what you guys think. Like, if you had no capital gains tax or a reduced capital gains tax, would that make you more likely to sell your property? I've talked to some investors in person. They said yes. I'm curious, for those that watch my channel, what do you think in the comment section below of that idea? Do you think it would free up a lot of inventory? One key point about that idea is it has to be limited only to investors that have owned for an extended period of time. We would not want to say to a short-term investor that they wouldn't have to pay capital gains tax, because that's going to lead to more short-term speculation. But if an investor has owned for over 15 years or over 25 years and is simply holding on to the property because they don't want to pay the capital gains tax bill, let's get rid of that disincentive to sell, give them a capital gains tax holiday, reduce the rate the longer they've owned it, and you're going to see a lot of listings hit the market, I think, over the next couple of years if that happens, which would drive home prices down in a really meaningful way, not just in the cities and zip codes where the corporate investors are most active. In fact, I think they should look at capital gains tax in general. Like, why should you pay it if you've owned your house for 40 or 50 years, whether you're an investor or a regular owner? Like, why should you pay when if you've owned and lived in your house for 40 or 50 years? It's kind of wild to me that the government still charges you 20%. Oh, by the way, they haven't indexed the deductions on capital gains tax for homeowners, single and married, since 1997. If you're a homeowner who lives in your house, you can basically not pay capital gains on the first $250,000 and the first $500,000 if you're married. Those were figures from 1997. They haven't updated those for inflation. So let's also update those for inflation so we help regular homeowners as well sell their house. Again, this is all about allowing people to sell their house. We should not have the government and tax policy restricting sales. Now, guys, you can let me know what you think about all this. I know I covered a lot of kind of technical stuff in this video. Let me know what you think. And of course, if you're a home buyer and investor, make sure to go to Reventure App, the program I developed. You can see the hat right here. Reventure App is a tool that's going to help you understand where the housing market's heading in 2026. Whether this investor ban happens or it doesn't, you're going to see the impacts on the housing market live in real time on Reventure App. We track the inventory and days on market and price cuts in all these different markets, and we turn it into a home price forecast that you could use to help you understand where the market's heading. Should you buy, should you not buy in 2026, and ultimately like how to negotiate. Go to www.reventure.app and sign up for a premium account to track the data in your market.